Hi, Dan Kerr's DK Analytics. Thanks for tuning in. It is April 2nd, Thursday, late afternoon, another beautiful day in Southwest Florida coming to a close. Got some very disturbing news today from the Department of Labor in the United States. I want to mention that, tie it in to a topic, and the topic of today's video is the bottom line, our cure, at what price? I'm going to stick with one valuation metric, the S&P 500. The S&P index closed at 2527, which produces or gives us a PE of 18 on trailing 12-month real earnings, GAAP earnings, generally accepted accounting principle, earnings per share. If U.S. GDP craters by 10%, S&P 500 EPS will become a sea of red ink. Earnings, or earnings per share, are a highly volatile residual of top lines, company sales. And those sales collectively comprise the economy. A single-digit top-line compression will typically turn earnings, or EPS, into stubs, or losses. A huge top-line compression, say if GDP cratered by 10%, will obliterate earnings, again create a sea of red ink. An L-shaped non-recovery will keep earnings on the floor. That is, we're not going to have a quick snapback from a deep downtrend to V-shaped, or a snapback from a bit of a longer term downtrend, U-shaped. We're not going to regain the earnings power we now are going to lose anytime soon. That's the story of an L-shaped non-recovery. How would an S&P 500 be valued at 25-27 in PE terms if all of a sudden, or if over the course now of the next 6 to 12 months, annualized EPS imploded by 80% from $139 this year to $28 per S&P 500 share, which, by the way, would be a very similar percentage S&P 500 EPS decline as happened from 06 and to 09, an 80% reduction. Does anyone think that a PE of 88 and S&P 500 at 25-27 currently would be sustainable, especially if it took another 5 years to regain peak earnings, as it did after the 06 S&P 500 EPS peak? Except this time it could take even longer, given that we're deeper in the mud, as I've discussed and we'll go into. Against this current S&P 500 valuation backdrop, let's consider some things. Jobs. Unemployment filings have reached 10 million in 2 weeks. In other words, 10 million people have lost their jobs and filed for unemployment. In this week alone, or the latest week on record, an absolutely historic, mind-bending 6.7 million people filed for unemployment insurance in America, lost their jobs, on top of 3.3 million that lost their jobs the week earlier. 10 million people. That is the equivalent of 6% of what was 159 million employed Americans. Let me share this chart that I've scribbled on here a bit to bring this home. I'm talking about this, right? This huge historic ramp up that we've never seen before, that has exceeded consensus estimates of jobless claims filed for by a 2- or 3-fold margin. Right? Now, with that in mind, and the lockdown local, national, and global economy that is causing all this, which is triggering a depression in the making of potentially unprecedented magnitude if we pursue this trajectory. How can an S&P 500 be at this level when earnings could be cut easily by 50, 60, 70, 80% or even more? Doesn't make sense, does it? Also consider the fact that more bailouts and pork are coming. Trump and the other Democrats / socialists, that's effectively what the Republicans are. They're both big government parties. Nobody is for fiscal discipline anymore, much less monetary discipline. The government in Washington, D.C. collectively wants to now spend $2 trillion on infrastructure, again financed out of an empty, highly indebted Uncle Sam pocket. They'll talk about the joint effort between private and public entities, but in reality, the private concerns require a bailout because business is shut down, right? And the public sector, the taxpayer, always ends up picking up the tab when things go screwed. And so it's in essence a taxpayer-funded infrastructure boondoggle here, pork that's in the pipeline. In addition, states are locking down their businesses, and more consumers need money that are out of work. Against that, consider a U.S. government running a deficit that could reach or exceed 18% of GDP. Consider an economy, the American economy, that has been financed to the tune of $600 billion, give or take, with an increasing trend annually by overseas financiers or creditors that have allowed or financed America's net trade deficit with the rest of the world. Those creditors are going to need their funds domestically because they're fighting the same lockdown, the same virus. Money printing. Consider money printing against this backdrop of the S&P 500. The Fed, the $5.3 trillion balance sheet Fed, is expanding the monetary base at a whopping $30.5 trillion at an annual rate if last week's balance sheet expansion is extrapolated. And they could well be doubling down on this. How can bonds remain in the sky with high valuations with this kind of monetary debasement? And by extension, on top of all the top and bottom line crushing news, how can stocks be valued highly if interest rates start to rise in net present value terms? The Fed's $425 billion injection from the Treasury, which comes from its stabilization fund, dollar and exchange rate stabilization fund, which has its roots all the way going back to Roosevelt's declaration that Americans need to turn in their gold. This injection, which I said the other day, will be leveraged roughly 10 to 1 to result in $4.25 trillion in bailout funds, which will once again be put to work to lift the fortunes primarily of K Street and Wall Street kleptocrats and the incestuous politicians and bureaucrats they're in bed with. Never mind if corporate chieftains engaged in debt binges and in stock buybacks, hello airlines that are also getting bailed out, or engaged in speculations that went sour. Those same intrepid captains of industry and their hangers-on, with compensation packages nowadays that are 400 to 500 times that of working stiffs, according to the Fed, compared to 40 times working stiffs 40 to 50 years ago, those intrepid captains of industry and their hangers-on, they will be saved by the Treasury and the Fed once again. They will be saved by the Fed and this federal government, yet the entitled class will not have to share a dime with the taxpayers that are footing the bill in one way or another if they end up making a lot of money down the road. Once again, how does one say privatizing gains and socializing losses at taxpayers' expense? How does one spell TARP on steroids? Or last September's repo bailout on steroids, which was a bailout for the hedge fund and private equity fund crybabies whose cost of funding, the overnight funding, 2-week funding, surged to 10% prior to the Fed bailing them out by expanding its balance sheet and forcing those repo rates back down into line with Fed funds policy. Because that surge, if price discovery had ruled to 10%, would have bankrupted the hedge funds and private equities, leveraged, racy balance sheets, and would have disrupted or ended their multi-million-dollar compensation packages. How does that help the overall economy or the S&P 500 earnings per share? In a nutshell, please tell me how all that has anything to do with free market capitalism, sound money, or fiscal sanity, or a robust private sector, much of which has been shut down, locked down. Please tell me how this isn't rampant, highly destructive, virulent statism for the vast majority of people. And how does one explain this collective insanity, this grotesquely unwealth of nations trajectory for 99% of the population, this anti-First Amendment don't assemble power grab, which might not be so easy to reverse? The Patriot Act comes to mind, and so do current day iterations of so-called social distancing scoreboards, which appear online, which use our cell phones to determine how frequently and how far we travel from home. Somebody crisscrossing a county trying to engage in business, he's going to be a bad boy. Someone staying locked up at home, not helping generate sales, he's going to be a good boy. A recent such scoreboard, which is on the internet, which is now set up on state basis, which will probably be drilled down to county by county, and then will likely be shared by the powers that be, locally, the state level, and federally. They took a look at Wyoming, where you have to drive 10 miles just to go to the post office and 15 miles to get some gasoline. They ended up being one of the bad boy states. My question in a bigger sense is, how does one rationalize all this ramped up statism and Orwellian behavior? Well, you guessed it, to save us from a coronavirus pandemic, of course. In fact, the administration over the weekend suggested that had it, or the Center for Disease Control, not intervened, America might be facing a catastrophic 2 million coronavirus death situation, instead of the still hugely disconcerting and incredibly sad, more recent potential loss of life estimate by the CDC in the US related to the coronavirus of between 150,000 and 200,000 people. I think this is over the top. I think it's demagoguery. Every flu or influenza season has elderly and compromised Americans and citizens the world over, shielding themselves from unnecessary exposure and virus transmission risks. This is common sense. Kids that are sick stay at home. Really sick employees, where they can, also stay at home. And especially older people would shield themselves from unnecessary exposure. It's as if the trillions of dollars of spending out of an empty pocket and massive pork and redistributionism, with more to come, are being rationalized and nationalized by the federal government as necessary to save precious lives that would have otherwise been lost. In this case, up to 1.9 million more American lives that could have been lost had the government not stepped in. Wow. Let's take another layman's look at this coronavirus response. The lockdowns, the quarantines, the stay-at-home quarantines. Only vital businesses can remain open, and so on and so forth. And also, let me review my sustained contention that the lockdown and bailout cure could well be worse than the disease. Once again, I say this not to minimize the huge risks associated with this easily spread and highly dangerous and deadly virus, especially for those with compromised immune systems or health. And I am saddened to hear from people such as the host of Crush the Street, Kenneth Amaduri, with whom I had a chat yesterday, who has lost a person close to him through the virus. Look, for all I know, I could be next, or I could tragically lose a family member or a friend thanks to this virus. So trust me, I'm not belittling this in any way. Yet, at the same time, we collectively face many threats to our existence, especially in a progressively aging society where we all are mortals. We don't live forever. As of last night, according to the CDC, the Center for Disease Control in the U.S., in America, 213,000 coronavirus cases were reported, and 4,513 infected people have sadly died. And a death toll will grow substantially, given America's relatively late entrance into this distressing virus chapter, which in turn is at least partly due to Trump's sage travel ban to China, in my opinion. Yet, there is gathering evidence that the rate of global coronavirus cases has been decelerating since the 20th of March, where the pace of growth was 19.3%. At the end of March, it was down to 9.9%. Of course, the law of large numbers also figures in. But the point is, hopefully, that bigger pool of people that have been impacted will slow down in terms of the growth or additional people that are impacted. Thus, hopefully, the currently reduced growth rate will be sustained and will weaken further. Plus, more encompassing data coming in terms of a much wider pool of exposed people, let's say, still not significant, but increasing amounts. All right, this is yet to be proven that this is in fact going to sustain itself, this positive trend that I'm going to mention. But the initial findings offer considerable hope. And what is that? That the more encompassing data with more exposed people showing coronavirus antibodies, that is, their immune system successfully put down the virus and thus are effectively arresting the spread of it at the same time. This is helping to not only better flesh out virus mortality rates, as I mentioned a few days ago, but such data examined by immunologists and their ilk at Stanford and Yale are increasingly pointing to a coronavirus mortality rate that is very loosely comparable to other flus or influenzas. That is, when death rates of generally healthy people are also included in the numerator, those that have perished, and in the denominator, those that have contracted the virus. For more a heightened sense of comparable illness or people succumbing to various things, in the U.S., the winter flu season typically costs between 30,000 and 60,000 lives. Also in the U.S., over 600,000 people tragically lose a battle against cancer every year. It's happened in my family, and I'm sure it has in yours too. Plus, over 800,000 people in the U.S. die of some kind of heart disease-related ailment each and every year, and over 39,000 people die in car accidents. My bigger point, despite the large annual loss of life in all the said realms, we don't lock down the country or the U.S. economy or the world economy. We don't engage in unprecedentedly large bailouts out of an empty pocket with historic levels of debt. We don't engage in unprecedented money printing on top of already unprecedented money printing to finance what amounts to a shutdown that will give us a depression in short order if we sustain our current policy. And our politicians and bureaucrats don't engage in increasingly questionable and worrisome house arrest decrees, threatening large fines if we assemble peacefully in any numbers, unless, of course, those assembled in larger numbers are at vital venues, from grocery stores to tax collectors. How can such policies be anything but largely destructive for society overall? Thus, my question, how can our virus response, if sustained or doubled down on, end well for the majority of people in financial, economic, or remaining freedom terms? Let me shoot from the hip a bit. Based on population-wide coronavirus mortality rate assumptions cobbled together from the mentioned sources. Again, this isn't the last say, but the initial readings of an expanding pool of tested people looks promising. It would appear reasonable to assume that over 99% of Americans that end up getting this coronavirus will survive. Probably well over 99% of all Americans that get this virus will survive. The question is, will our economy survive? Will capitalism survive? Will our Constitution, or what's left of it, survive? And what's left of free market capitalism survive? For those that are convinced that the coronavirus will be much, much more deadly, which I sure hope not, and who doesn't, and I think not, as I've explained or attempted to explain by taking some expert feedback and sharing it with you. That's feedback, by the way, from immunologists and scientists or doctors in related fields that have dared to speak out, including 2 German sources that I've listened to, and what they think about the coronavirus, specifically that it isn't going to be much different than traditional influenzas we deal with. That is, it's not going to be the next bubonic plague of the 14th century or the next Florence epidemic of the 15th century. Yet, those same individuals that have dared say this have gotten a lot of blowback and criticism This, how dare you understate the risk blowback, is coming from the establishment. That is, from the profit-oppressed media to numerous college campuses, to professors thereof, and to certain government officials focused on massively higher death rates in terms of a policy response and in terms of vested interests, which is anything but clean. And those vested interests obviously include taxpayer funding for all kinds of initiatives, not all of which are going to help out the virus dilemma. Related to that, note that the recently concluded $2.2 trillion U.S. government CARES Act bailout, $6.5 trillion once the Fed leverages the $425 billion the Treasury will hand over, or probably already has. This bailout sets aside a whopping $325 billion in additional bureaucratic funding. Can you see colleges calling? Can you see college administrators, cup in hand, rushing to the bureaucrats? Where am I going with all this, purely financially speaking? Let me first emphasize that, again, I in no way, shape, or form wish to minimize any loss of life, much less a catastrophic loss of life associated with a pandemic or a plague, when I state what I'm going to say, financially speaking. Most obviously, finances pale when compared to staying alive. What good is money if you're dead? Yet, if the cost of capital through our policy response to this virus becomes prohibitive, even more people will be at great jeopardy for the most obvious of reasons. Because in a depression, we can't finance solutions, much less a decent standard of living, much less adequate food and shelter for a lot of people. If we do, in fact, get horrific death rates, moving at least partly in the direction of a Florence mid-15th century epidemic or plague, during which a horrendous 20 to 25% of the Renaissance age financing hub of Florence, the population of Florence, died, then we can look at real or inflation-adjusted cost of capital that, if history is any guide, could be 15 to 20-fold higher than today's zero bound. And when I talk about this extreme middle age epidemic situation, one could be forgiven if one watches the news 24/7 that enough people believe that this is where we must be going, right? But let's say we go partly in that direction. What could this mean for the cost of capital? It's getting a bit dark here as I record this. I know hopefully this is going to work. All right, here we go. This is a chart, again, from Bloomberg. I gotta get another source. But what you have here is a 700-year cost of real capital, risk-free loss of real capital, which is just below 5%, right? Inflation adjusted, zero credit risk, that is investment grade governments. And here, this high watermark is the Florence pandemic around 1440 to 1460. And Florence was the financing hub of the world at that point. And look what happened to risk-free real rates of return. They went to 25% or more. Preceding that, in the 14th century, when we had the bubonic plague hit, all right, look at where real rates of capital were. Now, look at where we are today. We're actually, this ended in 17, but we're at the zero bound, as you know, given government decree or central bank tots. So we're way down here, way below the 700-year historical risk-free real rate of interest, all right, of nearly 5%, where again, we're at 0%. Let's say we go in the direction of a bigger pandemic than I fear and some other people fear, and that this ends up tripling, doubling or tripling our real risk-free rate of capital, our interest expense, right? Which would, by the way, from the zero bound, let's say we have 2 to 3 percentage point higher real rates, that would still be way below a long-term average risk-free real rate. But if we had that, it would clock our bond and by association stock valuations because of the ultra-long duration of a zero coupon bond, which is in essence what we have at 10-year government treasuries. And that clocking of the value of bonds would push up interest rates. Again, it turn into a self-feeding frenzy, and it would clock stock valuations from the second aspect, from the discount rate perspective, in addition to the hugely compressing earnings per share. So if we get a nastier involvement of this coronavirus, on top of all the other hanky-panky, our policy, it will crush our bubble bond and stock valuations, our absolutely unprecedented global bond market bubble, at least in investment-grade governments. And by extension, again, stock valuations from two sides, from both the profit and loss perspective and the discount rate perspective. So in our currently mad world of unprecedented fiscal and monetary Keynesianism with unheralded debt and misallocations, our policymakers, as if trying to bring the straw that finally breaks the economy's back, are fixated on strangling the goose that lays the golden eggs, the economy. So, in essence, we are doubling down on the very toxic public policy stew that has gotten us deeply into debt, misallocations, and cronyism, and even further removed from free market capitalism, creative destruction, letting firms that misplanned fail, price discovery, so we get sound allocations, sound money, so we avoid ruinous inflation, and a sane regulatory and legal framework so private enterprise can breathe, not just crony capitalism. And it is exactly, and this is what's so ironic, it is exactly our leveraged, declining productivity situation brought about by our toxic public policy stew that will ultimately demand even much higher risk premiums to offset our mushrooming insolvency and monetary inflation risks. That is, we could have, or we will have at some point, bond yields where the risk-free real rate of return has to be much higher still to offset the unparalleled insolvency and monetary inflation risks. Don't forget, in 1980-81, we had U.S. Treasuries, when the U.S. balance sheet was pristine compared to today, top out at over 15%, the 10-year and the 15-year. Well, I'd say no matter how you slice it, there is only one safe haven asset that does very well during both times of debt-induced deflation, not productivity growth company kind of deflation, but debt-induced deflation, living beyond your means, all right? Or the inevitable inflationary depression response that will ensue in economies that have fiat money. So gold, and I just gave it away, is the safe haven asset that does very well in both times of debt-induced deflation, and it does well in anticipation of what's going to be done about it. That is huge monetary debasement. That will not solve the underlying depression, right? This asset will sniff out that inevitable money printing response, and we're now seeing it unfold, so we're right at the threshold. These assets, precious metals, have been under pressure because people had to sell what's liquid, just like in 08 and 09. But this money printing response, as history has shown time and time again in fiat currency-based nations, not tethered to physical precious metals, has recently been on display in countries such as Venezuela, Zimbabwe, Sudan, Argentina, and Iran. I think you know that I'm referring to, obviously, gold, and I just gave it away. And I think you can add its little brother, silver, as history from Persia to Rome to America attests. That asset, or those shiny assets, will help you purchase select appropriate bonds, relatively good credits, and stocks, mainly high dividend yield blue chips in bed with bureaucrats around the world. That is when stagflationary fire sale prices turn those bonds and those select bonds and those select stocks into bargain basement assets with double-digit yields on bonds and single-digit PEs on stocks. Much like was on tap in the early 80s, as discussed, and will likely be on tap even more so when the dust settles this time around, and it might not take as long as you think to get there. I hope you found the bottom line, our cure, and at what price musings of interest. I want to sign off here. It is getting dark. It is April 2nd, 2020. Thank you very much for tuning in. It's Dan of DK Analytics. Bye.